Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment is Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss what strategies may be appropriate as we approach earnings season and the broader macro landscape. It is great to see the both of you, as always. And Steve Sosnick, despite the fact that we had a little break in the markets last week with the July 4th holiday, there really is a lot on the calendar for traders this week, particularly on the macro end.
Yeah, definitely. Great to see you both. This is, last week was, the epitome of don't short a dull tape, that adage where there's really not much going on. Even Friday's payrolls numbers proved to be kind of a non-event. Coming into today, we're sort of directionless, but we have Chairman Powell speaking in front of the Senate and the House on Tuesday and Wednesday. That's always got the potential to be consequential. And you have CPI and PPI Thursday and Friday. And lo and behold, earnings season starts again on Friday when JP Morgan and a couple of the other big banks report. And then we really get into it over the following couple of weeks. So it's been a quiet period, though there's reason to believe that it might not remain as such.
Yeah, and Steve White, I think part of the concern out of some of the macro data that we're seeing, I think the revisions to the jobs data was somewhat shocking. Do you think it's more of the labor market becoming more balanced, or is it signaling perhaps some tightness in the months ahead?
That's a $64 question, isn't it, Jill? And what's kind of interesting about this is we're starting to see some of the things that we would have expected to see from a Fed that had been tightening 500 basis points over a relatively short period of time. It's taken a lot longer than we thought for some of these cracks in the economy and the consumer start to show up. But we're now in that point where both stocks have moved up pretty considerably. Earnings estimates have continued to ratchet higher. The risks of the economy weakening from here are higher than they were 18 months ago. So I just think we're in that period where it's kind of like, be careful what you ask for. We want things to slow enough for the Fed to be able to reduce interest rates. And based on Friday's number, and I put out some commentary on Friday, and I said, what the best thing about this number is it's not so far away that it's going to cause a lot of problems when desks are basically empty on Friday after July 4th. But this is where the Fed, and I'm really interested, as Steve mentioned, to hear what Chair Powell has to say when he's going to be asked about the future of monetary policy. Does the slowdown in the labor market, jobless claims have been in a bit of an upward trend. We're seeing some weakness or softness in the JOLTS data as well. Everything is pointing to the fact that growth is ratcheting down a little bit. Is that enough? I think the outlook for core CPI on Thursday is to stay stable at 3.4%. That's still above 2%, and staying at 3.4 is not further progress towards that 2% target. But I do think there's a risk. This is where the Fed needs to be really careful, and it's just going to be a call on the part of the Fed. We tend to think they're playing the long game on inflation. We know the history of inflation to come in waves. This Fed doesn't want to be part of a historical review that says they ease too early, but we're just at that point, since monetary policy acts with that lag, that they've got to be really careful about what they do from here.
Yeah. Well, Steve Sosnick, that's really what the question is. Was patience a virtue for the Fed, or perhaps they waited too long? Because now they're in a situation, if the economy does get to a point where it declines and we need several rate cuts. I mean, to me, having one or two rate cuts, I can live with that. But if we start to see 3, 4, 5, that's a bigger issue within the economy itself.
Absolutely. And that's why I think the July meeting, the end of this month, is going to be so consequential, because the question we have to wrestle with now is which is really going to take precedence. Is the if you have a data dependent Fed, it's clear we're slowing down a little. Are we slowing down sufficiently that the Fed really needs to get into gear and sort of abandon the 2% target in favor of a little economic stimulus? Or do they continue to wait for that target to be met and risk having some weakening in the economy? We made it through this year thinking that we'd somehow we started the year, I should say, thinking that we would get somehow decent economic growth and 6 to 7 rate cuts. Well, that was it was mutually exclusive. It was incompatible. And I
Right.
think we came out on the correct side, which is a stronger economy, I think benefits us way more than an economy that requires multiple rate cuts. But as you mentioned, Jill, if we get to that point where we need multiple rate cuts and the Fed isn't delivering them, that's actually quite a bit worse. And the other problem you get into is September is, the last meeting before the election. Does the Fed want, if it's a judgment call, if it's close, if it's a coin flip, whether to cut or not cut, do they hold off until the November meeting, which is the day after the election? So therefore, they can't be accused of interfering at that point. This is a lot of moving parts. It'll be very interesting to hear Powell's press conference, as it always is, after that meeting. It'll be also very interesting to see what the minutes relate
Mm.
when those come out a few weeks afterwards.
Right.
You know,
I'm sorry, go ahead, Steve.
yeah, Jill, I'm sorry to jump in there, but look, I want to add to what Steve's talking about. In one sense, that it's almost like the Fed is damned if they do and damned if they don't on monetary policy at this point. Whether they ease, and I would say this too, there's a big difference between them lowering rates to keep the amount of restrictive policy the same versus easing. I don't think the Fed they don't want to ease. That's not what they want to do. But they don't want to let policy become even more restrictive because inflation's continuing to trend down while they stay the same. But I think with the timing of this, if they don't move before the election, half of the electorate's going to say they were helping the other side. If they do move, the other half's going to say they were helping the other side. So look, I think this is where, and Steve's right. It's not that the July meeting from our stance is going to be a live meeting. We don't think anything's going to happen there, but the language of how he's laying out what's going to happen between now and the end of the year is going to be really important as it sets the tone for the market on what to expect. They updated their statement of economic projections at the June meeting. What do we have actually in the set with the dot plot? 1.5 cuts. So it could go either way. I do think they are data dependent, but I don't think that the election is anything more than probably something that they need to be aware of from a communication standpoint. How the data comes in, I think, is going to set the timing of whether they do it in September or November.
Right. Well, Steve Sosnick, let's talk about this. Speaking of the election, how do you think the markets have digested it thus far?
I think the markets have done their best to ignore it. The bond market has paid attention. If you notice that bump up that we got in yields on the day after the debate and the Monday after the debate, that was quite substantial, particularly on Monday, when you had ISM numbers that pointed to a lot of weakness, and yet bond yields rose 7 to 9 basis points, depending on where you were on the curve. We've since gotten most of that back. The rationale for bond yields going higher is the thought that a Trump administration would probably impose tariffs and reduce income taxes in a manner that probably would expand the deficit even further. Whether that's true or not, it's tough to say because it's always, it's kind of a moving target in that regard. But that's at least the going perception. In terms of the stock market, it doesn't really have an opinion one way or the other. Quite frankly, it's still, can you get AI earnings out of Nvidia and friends? I think the stock market's kind of punting on this one. And to some extent, and remember also, the US stock market ignored two very consequential European elections over the past week, right? The UK had a big election that went as planned. It was July 4th. We were closed. It's the UK. It's the other side of the Atlantic. Big deal. And then, France threw us a little bit of a head fake over the last 2 weeks where it looked like they were lurching right. Then it turns out they lurched left. Turns out after all this, it's going to be a divided government no matter what you do, which actually markets tend to be most happy with, is a little bit of gridlock. And so I think with this election too close to call on so many levels, not just presidency, but in terms of the makeup of the House and the Senate, I think right now stock traders are never particularly good at geopolitics or politics in general. And so I think for the short term, for the most part, everybody's punting.
Yeah. Well, I mean, and that's a great point that Steve Sosnick makes, Steve Wyett, is it really does matter. It comes down to the composition of it's a divided government or if it's not. I mean, it's divided right now. Look how ineffective it's been out of all, Congresses and houses put together. If you look at it historically, I mean, I think there are under 100 bills that have actually been passed. So that tells you something right there. But let's think a little bit more near term than that. As we're going into earnings season, perhaps this is almost a sigh of relief for investors. I mean, all we've heard about is Microsoft, Apple, and NVIDIA, and there are other stories out there. So when you think about positioning going into this over the next 5 to 6 weeks, what are your thoughts here?
Well, I'm really anxious to hear how Steve's going to answer this question as well, because he's probably a little bit more of an expert on that. But you're right. It's kind of like if you look at the market, and when we say the market's higher, Jill, what we're really saying is you got about 6 or 7 stocks that are higher, and then you got 493 in the S&P 500 that haven't done much of anything this year. And so you can build a case that the index is not really reflective of what's going on. I think the S&P, Steve's up 17.5% or so today, but that's 6 stocks. So our sense is the message of the market more what's going on we see with McDonald's or Walgreens or Nike, or is that Microsoft, Apple, and NVIDIA? Here's the thing. We're anticipating that the earnings that we're seeing within the AI trade are going to continue there for some time. So there's no reason to think about really backing off on those. And in fact, if you do a breakdown, we did a breakdown of the performance of like large cap growth through the end of June. Multiples are actually down this year, but stock prices are way up, but earnings have been growing faster than the stock prices have been going up. So if you look at it from that perspective, you can say, is this starting to look like a bit of a bubble here? I mean, if you just look at price activity, you can say that. But if you look at multiples, it's not like we're putting these humongous multiples on companies that aren't making money. Now, I think there's a reasonable question to ask as to how long NVIDIA can keep 70 to 80% margins on their products over what period of time they can do that. I think back to late 99, early 2000, I think Cisco had like 50% margins there for a while too. They were not able to keep those margins for forever. So I don't think it can go on indefinitely, but at this point in time, we're not saying that you need to be making any major changes. We're pretty diversified in our approach, which I guess, Jill, means, we've kind of lagged what's happened with the S&P 500 because we own mid cap and small cap stocks too. And I would love to see earnings and performance broaden out beyond the 6 or 7 stocks that are really kind of driving stuff.
Yeah.
To pick up on that, even among the top 50 names within the S&P 500, there's huge divergences. The correlations are really pretty much at record lows in terms of within even the biggest cap names. When you're also looking at a situation where the top 5 or 6 names among the S&P 500 are at a record level of concentration. Again, the good thing here is these companies are making money, and investors to a large extent are paying up not only for the earnings power, but just sort of for the market power that these companies possess. My fear going forward, and we won't know because NVIDIA's got an extra month in its earnings, it's off cycle by a month, is what happens if you have NVIDIA pull in a performance like Micron did after its earnings, where they beat pretty much on every measure across the board, and the stock sank anyway because the upward guidance that the market was hoping for wasn't good enough, despite by any measure it was a blowout quarter. So you're starting to get to the point where are we priced to perfection? Are we discounting into the hereafter? That kind of thing. As Steve mentioned, the earnings power, the earnings growth of these companies is tremendous. But how much do we pay for that, and how much of a risk is it? Because what this tells me is if you're being driven up by a small cadre of stocks, if there's any stumble in them, well, then you have no choice. There's no one really left to buy that dip, which is why one of the things one of the strategies that might work for people, it's a bit of a weird one, is, just keep going all in on these winning names, but buy yourself insurance because it's relatively cheap. If you want to buy puts on QQQ or something similar, and I would focus on NDX actually rather than SPX, because NDX is driving the bus, and I'm not just saying this because we're on a Nasdaq call, but really it really is the Nasdaq 100 stocks driving this. So do you just sort of focus on these names that keep working? Don't fight the momentum, but realize that it's relatively inexpensive to insure your portfolio. And, as with most insurance, you don't want your insurance to pay off, but you sleep better at night if you have it. So that's one way to look at this. I don't necessarily recommend it for everybody, but that's, for a very risk tolerant investor, a way to approach this.
All right. Appreciate your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.